Welcome to the weekly update. And before I get started, for those of you that usually watch the weekly videos, you'll notice that this is a little bit different format. I had a hardware issue over the week, and I'm not able to use the regular computer that I use to record the videos. So I have to go to another computer, and this is all just take one. So please forgive me in advance for words that I stumble over or things that I say wrong or flub up. I just have to do this all in one take and just hope for the best. All right, let's go over what happened last week. It was a brutal week, one of the most brutal weeks we've seen in quite a while. Sentiment is very extreme. We're hitting some oversold levels. People are not happy about what's going on. They're not happy about the future, and things just don't look very positive right now. So I'll break that down in the video as we go through. Before I get going, though, I do have an announcement to make. I am starting to open up the membership for my program, and I'm going to be preparing a video over the weekend where I go into more detail about just what I have to offer you and what will be involved with all of that. So please, if you're interested in something like that, check out that video when I post it. I'll still be posting videos on YouTube pretty much like I am right now, but there's a lot more that I offer in the program. Also, please double check your YouTube subscription. I had something come through my account, and all of a sudden my subscriber base just went way up, much higher, and it looked pretty silly. So I contacted YouTube. They went through and wiped out all of the bogus accounts. Well, sometimes they might wipe out legitimate subscriptions as well. So please feel free to go check on that. I'm going to start using the spxinvestingblog.com more because of the program being launched, because there are sometimes, especially on a daily basis, when I may not be able to prepare a video, I don't have any other way to contact you or let you know what's going on. So what I'll be doing is posting things on that blog just to let you know I can't do a video, it's going to be late, I hope to get it up soon. Just any kind of information that I feel that you need to know. Also, please be aware that the markets are closed on Monday, and there will be no daily video this coming Friday. I have some commitments. Now, this is the weekly video, and if you only watch the weekly video, then fine. This doesn't apply to you. Also, I took out the technical overview, both on the daily videos and on this video. It's always the same. The things that are going up continue to go up. The things that are going down are continuing to go down. So I just didn't feel that that was really adding any value. I'm watching things, and when it does get to the point where we're seeing changes on a more consistent basis, I'll bring that back very easily, but I'm just not including it for right now. All right, so let's go and look at the past week and then see how things look for June 21st through the 24th. We have a lot of notes here. In fact, I have 3 pages of different things that happened. There were a lot of rate hikes this past week, not only by the Fed, that's the biggie, and that's what affects US investors the most and those that invest in the US markets. But Brazil raised their rates, the UK raised their rates, Switzerland raised their rates. Last week, we had Australia and India raise their rates. So this is not only happening in the US, it's happening globally. There's also some real concerns right now in the crypto markets. We're seeing liquidity issues because everything is tanking. And in fact, right before I started recording, I think Bitcoin is now down into the 18s. It actually dropped almost down to 17 there for a while. But who knows what's going to happen with all that. But you have some real problems in that market right now, which is biting into a lot of confidence. There are also earnings concerns in the stock market themselves, and that's ultimately what drives stock prices. If a company is going to increase their earnings, that justifies their stock going higher. If they're going to decrease those, then that calls for the stock going down. We're also seeing a real widening of the spreads in junk bonds, and that's usually indicative of when there are some economic uncertainties or downright problems. There's real volatility right now in the treasury markets. We're seeing interest rates flying all over the place. As bonds go down, interest rates go up, and vice versa, and things are just really moving. There's a lot of problems with investor confidence right now. It continues to fall. And think about that. If you have your life savings or a 401k or something in the market and you're seeing a big percentage of that floating away right now, yeah, that might bite into your confidence a little bit. And especially when what worked a couple of years ago, buy the dip, buy the dip, buy the dip. Well, that's not working now. We're buying the dip only to have further losses. When's that going to stop? And people are really confused right now. We're also really worried about recession problems and also stagflation, where we have really high interest rates and no economic growth. The US dollar, that was the place to be over the past week. That's really the only thing that went up. Oil ended up falling 10%. It got up to 120 and even above that, and then it fell about 10% down to 108. So are there problems starting to happen in the oil market? Is it going to bounce back up? It's become really the rage lately to be in the energy sector and then in oil. Well, when everybody starts flocking in that direction, that's just about the time the party's over. But it may still go on for a while, and people might end up making some profits from that. Over the past week, all 11 of the S&P 500 sectors declined, and I'll show you a brief chart of that. Part two here, I have even more. The Dow ended up falling below 30,000. I know that's a big deal. It doesn't really matter much to me. On the financial media, it's like up 100 points, down 100 points. I don't care about that. I deal with percentages. The only time I really deal with point values is when I'm doing some kind of option things. All the major indices ended up setting new 52-week lows, including the S&P 500, and it did it a few times throughout the week. The energy sector really declined due to concerns about a major slowdown in global demand. And this is not being helped by interest rates going up. When interest rates go up, that really slows things down. Companies can't buy new equipment. Companies can't build new things that rely on energy. The Fed, you probably know this by now, they raised interest rates, or the Fed funds rate, by 75 basis points. We're at 150 to 175 right now. That's the range. And the projections have been raised where, well, we're going to get up to about 2%. Really, they were saying 1.9%. Well, now they think when they're done with all of this, we're going to be at about 3.4, 3.5%. That's just a projection. So that could always change. It's already changed. The real GDP growth projection, it was revised down over the past week to 1.7%, where it had been 2.8%. But then there's this other thing out there called the GDP Now model. And I have a chart of this later on where there's really nothing to show you because it's zero. They're not predicting any decline, but they're not predicting any advancing either. So there's just nothing there. Where it had been projected to be at 0.9%. So that's lowering what this model is telling us. The PCE price inflation projection, that's what the Fed really likes to use. It was raised. It had been at 4.3% for the inflation projection. Now it's at 5.2. Then after the Fed met on Wednesday, Chair Powell, he came out and had a press conference, and to try to sum things up a little bit, basically just stated that the Fed, or the FOMC, is likely to raise rates another 50 basis points. The market's really banking on, no pun intended, 75 basis points at the next meeting. But if we still see some more weakness, that could change. This scenario of raising it 75 just was created since the CPI came out a week ago. That's how quickly things can change. It was looking like they were going to raise it 0.5%. Well, then the CPI came out, blew everybody's minds, and really ruined the scenario that maybe inflation had topped and was starting to go down. That bumped up the expectations that no, 0.5% isn't enough. They're going to have to raise this to 0.75%. And there was a lot of people even saying we need to be 1%. So there's all the debates going back and forth. What Chair Powell is trying to project is that he and the Fed are committed to getting inflation under control, even if that means some pain to the financial markets. He sees inflation as the most important thing right now. Another thing that's kind of interesting, and if you watch my videos, every once in a while, I mention this long-term situation in Japan. They're having some real problems there. And part of it was played out this week, where the whole world is raising interest rates, but not Japan. They're the outlier in this whole situation, where they met and decided to not change their rates that are already at minus 0.1%. They have negative interest rates in Japan. And they're trying to keep the 10-year bond that they have in Japan around zero. And I'll have a chart later on where it shows the US and the UK and the European Union, shows all these other things just skyrocketing up. Germany, that's what I was trying to think of. Here, this is part of the Take One videos crowd. So here we go. But they're not doing that in Japan, because there are some deep problems there that have been developing for decades, and we'll have to see. Is this going to play out in the future, and will that bleed over into the US stock market as well? While that's happening, the yen continues to fall, and that's part of the reason for the dollar strength, because it's been going up against the yen. And then the European Central Bank, or ECB, they got together on an emergency basis on Wednesday, and they're just trying to come up with a plan. They didn't do anything with interest rates, but they're like, how can we get these bonds under control? They're flying all over the place. Interest rates are just shooting up. Inflation is out of control. Growth is really going down. They're having the same problems too. So they just met over the week. Whereas the UK, I didn't have that on here. The UK did raise their interest rates over the last week, but not the European Union. Remember Brexit? They don't belong to that anymore. Then going on to our next part, we were down 5.79% for the week on above average volume. We were above average pretty much every day, but then we really spiked on Friday because it was quadruple witching. So that really adds a lot to the average volume. The technicals, yeah, they're negative, and I'm going to sound like a broken record as I go through the charts here, but there could potentially be some positive things to watch out for. And I have some different charts that I'm going to show you closer to the end of the video, and well, kind of throughout the whole video, that might give you some hope, or at least some things to go, okay, let's watch for that and see if that happens. Inflation and interest rates are the real concern, which also produces a lot of growth concerns as far as the stock market is concerned. Geopolitical concerns, yeah, Russia, Ukraine, all these weird things going on, which at any moment could come to the forefront. The supply chain issues are still there. It's my understanding that they haven't lessened the lockdown. Well, they've lessened the lockdown in China, but they're still doing a lot of testing, and some places are still locked down. Oil's been just going all over. It actually kind of behaved. Well, I shouldn't really say that. It behaved on Friday, but it was down heavily on the week. We had a lot of Fed speak over the last week and policy, and everybody's trying to guess, where do we go from here? And then the different earnings reports that come out on a daily basis. Our trend is negative and getting stronger on the weekly chart. All right, so for the Dow was down 4.8%, as was the NASDAQ. The S&P was down 5.8%, and the Russell 2000, the small caps, they got really hit, being down 7.6% in the week. And this just shows you on a 5-day basis how everything performed. The NASDAQ, at least right here, because it ended up being up on Friday, it did a little bit better than the other markets, where the small caps really got hit the hardest. Looking at the sectors, all of them were down. And look at the top one. I have these sorted according to what was the most. Energy was down 17% in 1 week. If a week ago you decided, I'm getting into energy, I'm going to get into the energy sector ETF or a mutual fund or something like that, or I'm going to get into oil, boy, that was probably the exact wrong time to do that. when everybody's talking about it, when it becomes the rage, most of the move is done by that point. But all of the different sectors ended up being down on the week. The one that kind of fared the least worst were staples. They were down 4.3%. And this just shows overall how things performed over the last 5 trading days. Everything was down. Current market valuation still has us set at fairly valued right now. We don't have the handy dandy little charts behind here. I don't know what happened. I like that feature, but the yield curve is still fairly valued. The Buffett indicator is fairly valued. We're still overvalued on a PE ratio basis. Interest rates and margin debt are fairly valued. And because of the decline, we're getting close to the mean price of the S&P. So they have it back more to fairly valued now. As far as sentiment, we are getting extreme negative again. And this just shows where we're at after Friday's session. The VIX did see an increase on the weekly chart, but not necessarily at a spike yet. But we did see an increase overall on the line chart and on the bar chart. Individual investors are very pessimistic again, which could be positive. When they all feel the same way, the opposite tends to happen. But see, a lot of people know that now. And so it's like, yeah, I'm going to get into the market because individual investors are very, very bearish. And then we end up falling even more. This doesn't mean it's going to change instantaneously. It just means that a lot of people are feeling the same way at the same time. Then I went to the website and it showed as of June 15th that 19.4% are still bullish on things, where you have 58.3 who are bearish, and they don't really count the neutral folks. And here's their little speedometer looking thing here. The Ridex bear bull ratio did spike up, but not necessarily at an extreme reading currently. The Ulster index is continuing to go up, which just means a lot of fear is increasing in the market. The Chicago National Financial Conditions Index is going up, but we're still under this black line. So that means things are okay, but we are advancing here. The spread between high yield or risky bonds and those that are not as risky, it's starting to go up, but we're not necessarily spiking yet. But if we have a real problem, this could go up pretty quick. I mean, look how fast it went up during the meltdown in 2008. It really spiked up when we had the COVID plunge. So just be aware of that. Looking at the 3-month volatility of the VIX, we're doing okay overall, but it is going up for the most part, just to kind of get a little longer term at how fear is playing out. We also had the active asset manager survey. And it's too bad. I usually do this myself with the software on my other computer, and I can't do it, but it's covering up. We had been at 50 last week, and that's more middle point, where with the declines that we saw last week, we declined to 32. So it's probably safe to assume that this is going to fall in the next reading as well, since this is a week behind. Then here's a headline. This is from FactSet, where it says analysts continue to have an unusually high number of buy ratings on S&P 500 stocks. And here's a chart that goes along with that. The green line along the top, these are the buy recommendations. And the yellow line are hold. And then way down here at the bottom are the sell signals. And I go through this in my classes and I talk about why it is this way. I don't want to get into it here, but we're seeing that kind of in earnings too, where they might be cutting earnings for right now as far as what they're projecting, but they're not necessarily cutting them into the future. And if they start to do that, that could really change some things for the markets. Then this is the GDP now. There's nothing here because we're down to 0. All right. And the insider transactions, we're more into neutral territory right now. When we break above this level, that's when we start to get more bearish. We had been below this level. Well, now we're starting to go above it. As far as earnings and valuation, this just shows the different drawdowns that we've had since about 2013 and where we're at right now. I mean, if you didn't already know. And then these are the returns that we've seen in the S&P 500 since World War II. And we're right in about the middle right now, being down about 24%, where the median is also 24%. And then the trajectory of the LEI, the leading economic index, that's the blue line. And it came out on Friday and it's starting to roll over a bit, where the coincident, that those are the reports that come out that tell you what's going on right now, not what's going to happen in the future. It is still going up overall, but this could potentially signal an economic slowdown into the future. Here's the current update on the earnings estimates, where Morgan Stanley is still below what the consensus estimates are. FedWatch, and then I'll make this go away for a little while. I just wanted to show that as of Friday, there's an 86.2% chance that there's going to be another 75 basis point move at the July 27th meeting. And that's where it stands right now. And then in September, they're a little bit more split, but then they're thinking it might go from 1.5 to 1 3/4. And we will eventually be at 2 3/4 to 3 at that point. That's kind of the running scenario right now. Then this just shows how Fed tightening always breaks something. They're always there to ruin the party. This is the opposite of a soft landing, that they raise interest rates and they do it too much. Well, this time, a lot of people are concerned that they didn't get going soon enough, but are they going to end up overdoing it? And this just goes back to different times in history when rates ended up being too high, the economy ran into a lot of problems, and then they had to start lowering interest rates really fast. Here's the Edward Yardeni chart showing the Fed balance sheet, which is supposed to be declining now compared to the S&P 500. And is that going to have an influence? Because a lot of the support for the markets has come from all this liquidity and QE that's been added to the stock market. When that starts going away, what's that going to do to prices? Then I couldn't update this one either. We fell down to 28 or so with the current CAPE. But this is the same chart that I showed last week, and where we were at 30.5, we're at 28 something now. So it did decline as we saw declines this past week. Looking at breadth, we are negative, both based on price and volume. The AD ratio, it actually bumped up a little bit, but we're still below 0 overall. So it's negative. The new highs and new lows, a lot of new lows were being created. So we're seeing a real decline looking back 4 weeks, as well as looking back 10 weeks. Accumulation distribution just shows that we are negative there as well. Our trend continues to advance with the red line on top, and it's going higher. So we have a negative trend that is getting stronger, according to that chart. The Arun, I can't even show the Arun on the daily videos now. It's all mixed up, where it's showing this red line. When it's pegged all the way to the top, that means sellers are in full control. When the green line's at the top, that means buyers are in control. Well, we're seeing sellers really spiking up as buyers are coming down. And when you compare the two, our oscillator below is really declining. Pretty negative right now based on this chart. Long term, we're way below the 50-period simple moving average on the weekly chart. And we had a death cross and we're well below. And you're going to see that over and over here. Death cross below the moving averages. I'm going to say that over and over. We are still below S1 on the weekly chart, and we have S2 way down here. And you can also see where volume really spiked up over the past week. The McClellan oscillator is extreme negative. The Swinland trading oscillator, based on price and volume, getting to extreme negative. The PMO, really declining based on price and volume. Not necessarily extreme, but sometimes this has marked a bottom in the past. The PMOs that are rising, extreme negative. The buy signals, extreme negative. And those that are above 0 has really been declining. And you could even say extreme negative. All of our oscillators on the weekly charts are negative. Bullish percent index is negative and really dropping down. This is the COVID low down here. Are we going to keep going down to see how that goes? Chaikin oscillator, also extreme negative. Bollinger Bands, almost extreme negative. Chaikin money flow, quite negative. EASA movement really declined on a 1-week basis, and we're declining on a 14-week basis. The force index is really declining. KST has been declining, but you would have missed a lot of this move up, but it's just kind of confirming that we're already going down. The money flow indicator is starting to get extreme negative. The PPO also didn't really help us all that much, but it still shows a decline. Ultimate oscillator is declining and not necessarily extreme. The rate of change, we kind of overdid it on a 1-week basis. Doesn't mean we're going to stop and go the other way. We could still fall even further, but we're starting to get extreme when we look back 50 weeks with the rate of change. RSI, very negative, but not necessarily extreme. Stochk RSI is extreme negative, as is the Williams percent R. The vortex is negative because the red line is on top and advancing, where the green line is on the bottom and declining. The summation index is declining based on price and volume. The Kopik curve really isn't doing much for us right now. It only helps us when it's going up, and it's not. The mass index, we're waiting to see if we could drop down to this dotted red line. We had one of those on the daily charts, but it really didn't lead to anything. You could go back and say, well, it gave that signal right before we started tanking lower, but we had a lot of other signals that were suggesting that we could pop up. So I don't really see that as a valid signal. Whoops, special K is still positive, but declining. We are still below the weekly Fibonacci level at 38.2. This is measuring from the COVID low to the all-time high. That was pretty significant support. The next level now is around 34.94 or so. Different charts, the Heikin Ashi is negative. The Kegi chart, when it's red like this, that's negative. We had some new zeros drawn in on the point and figure chart. We have a double bottom breakdown that was generated back on June 13th. Renko is negative with the red boxes. 3-line break is with dark candles, so it is negative. Looking at the broad market, now here's where I'm going to sound like a broken record. Death cross declining. NASDAQ, death cross declining. Now, we're seeing this on the S&P 500, but we're also seeing this on the NASDAQ as well as some other indexes. This is the NASDAQ itself right here. And this is a weekly chart going all the way back to the year 2000. This blue line is the 200-week moving average. That's a long moving average. We're coming down to that level, and we've actually broken below that a little bit on the NASDAQ. We haven't quite reached that yet on the S&P 500, and I'll show you that here in just a moment. This could be pretty significant because in the past, even when really bad things have happened, this level has tended to act as support. And if we break through that and keep going down, that really will shift everything much more negative. NASDAQ 100, death cross declining. NYSE, death cross declining. Here's the NYSE also coming down to the 200-week moving average. See, we're seeing a lot of these kind of converging together at the same time. If we bounce up off of that, we might get some kind of a recovery bounce. Whether that's going to turn everything back rosy again, we don't know that at this point. But we do know if we break below this, that's going to turn things very, very much more negative than they already are. The Wilshire, death cross, decline. Small caps, death cross, decline. Mid caps. Here's looking at all three of the indexes together without any studies on here. Sometimes this is what I like to do. Just look at all three of them at the same time. No moving averages, no oscillators, nothing. And sometimes that can be helpful. Here's Dow theory, looking at the Dow on the top, how the trannies really had a down week. And utilities, which had been one of the better performing areas of 2022, they just got hammered this past week. All stocks, which takes US and non-US stocks, is really in a decline. FANG was down 4.58%. ARK was down 3.27%. The 30 biggest software companies are in a solid downtrend. The Elder Impulse system is negative because we have a red bar. The SAR is negative with the dots on top. The broad market, the CRB, it got hit pretty good over the last week too, but it's still above, or it's right about at the 13 period moving average. So the uptrend is still intact, even though it pulled back. The dollar, it was the place to be. As I said earlier, we haven't quite surpassed the high that we set recently, but it was up strong. Oil, after really getting up into the 120s, it came down and settled at 107.99. The gold ETF, and this is what's really interesting, and I don't know if I mentioned this on the weekly video or a daily video, but I was listening to a podcast and they were talking to a gold expert, and they asked him, how come gold isn't going up? And he said, I don't know. I just don't know. It should be going up. It's just not going up. So, and he's supposed to be an expert, where silver is also having a lot of trouble right now. Looking at interest rates and bonds, we're in a downtrend based on price and a real uptrend based on yield, even though we came back down, but then we turned back up later in the week. But we can just see how interest rates are just going up and they're all bunching together. And we have a few of these that are inverted with each other. It's just a crazy time. Intermarket analysis, even though oil had been doing the best, it's still doing the best, but well off of its highs. The dollar showed some recent strength since the beginning of the year. Gold is just barely positive, where we have stocks and bonds have been decidedly negative. Looking at some relative markets, bonds are starting to outperform stocks. As bad as bonds have been doing, they might be breaking out, but we just want to keep an eye on this for right now. It's also showing this on our monthly chart, where stocks had broken out and are now starting to come back down. And that was a high set way back in the year 2000. So if we do start coming back down, this is likely to act as support right down in this level. Growth and value, growth underperforming value by a lot. The S&P 100, this is a little bit encouraging. We're seeing the 100 biggest stocks actually doing better than the rest of the S&P 500. They're still negative, but we saw a nice improvement over the last week. NASDAQ 100 turned up just an itsy bitsy bit against the S&P. Gold, it's not that gold is going up, it's the S&P is going down. That's what's helping the ratio right now. And gold to the US dollar declined because gold stayed about the same and the dollar was stronger. Low volatility stocks also are in a stronger uptrend when compared to the SPY. Energy, yeah, it's been going up really solidly when you compare it to tech, but we're seeing some recent weakness. Discretionary against staples, just not looking good. Now, this is an area that I usually just go over on the daily charts, but since I know some of you only watch the weekly video, I want to at least expose this to you. I'm going to be showing some daily charts here, just something to look at. One thing that we're seeing is this is a 5-period simple moving average of the equity put call ratio. All right, that's the purple line down here. And when it gets to a really high level, not necessarily right when it happens, but you can look at the S&P above and see, that quite often marked a bottom in the market. Well, we've climbed above 0.8. We're a little bit below that right now. This will change on a daily basis, but this could signal that we're potentially getting to some kind of a bottom. Whether it's going to be a major bottom or just a bounce, we don't know yet. This is another thing that's interesting. When you look at this chart on the top, you see where the S&P is making a lower low. Well, when you compare the QQQs with the SPY, we're seeing a positive divergence. Discretionary against the SPY, positive divergence. Large cap growth against large cap value, positive divergence. That's pretty cool. Now have some more. Growth versus value, positive divergence with the large caps. Mid caps, bullish divergence. Small caps, bullish divergence. Is this going to continue or not? I don't know, but it's something positive that we can look at right now. Then this is another thing that was brought to my attention this past week. This is another chart that we already showed. This is the weekly S&P 500 and the fib levels going from the COVID lows to the all-time high. This is the 200-week moving average. Remember when we saw that on the NASDAQ and the NYSE? This is the 200-week moving average for the S&P 500. And we're noticing that the 50% retracement and the moving average are converging with each other. This could potentially be support. Now we're going to have to fall quite a bit. We're at 3674 now. To get to this, we're going to have to go down to 3,500. So that would still be a significant decline. But if we do that, that could act as support. That could freak everybody out. It could wash out all the emotions that are going on where we lead to some kind of capitulation. Now, the thing to be really concerned about, though, is if we do come down to this level and everybody freaks out and then we keep going, that's when it could be really nasty. So try to see both sides at the same time when possible. Another thing that could be positive is we're looking at stocks in the S&P that are above their 200-day moving average. We're getting down to a pretty significant reading right now. If we fall a little bit more in the S&P, this is likely to fall as well, and we might start to get an extreme reading. And this is the 200-day simple moving average. So this is also a long term, not as long as the 200-week. This is 200 days. But when you see a convergence of a lot of these things at the same time, support levels, moving averages, both long and even longer term, all kind of coming together, plus on different indexes, that could be potentially positive, I think, or at least worth noticing. So what's our outlook for the upcoming week? On Tuesday, we have existing home sales. Then on Thursday, jobless claims. Friday, new home sales. Not an awful lot on the economic front, and what is coming out has to do with real estate. Things to watch, of course, these are the same things that were at the beginning of the video. So I'm just going to pause and look this list over instead of reading this thing off to you again. So what is our scenario looking for Tuesday? We are negative. That's as far as I can go with our scenarios. Because of all the things that are on the list on the previous slide, we are very negative technically, but we're oversold, both in the short, intermediate term. We might be getting close to being oversold in the longer term as well. So that's what could keep things going down. Just keep doing what's been going on. What could help things go up? We are oversold. There's a real disbelief. The market's never going to go up again. Oh my gosh, it's doing so bad. That's about the time when it turns. And then these possible positive setups. Now, some of the other setups that I talk about, those aren't happening right now. These are different ones than what I usually talk about in the daily videos, because those ones are just not viable at the current time, such as the Staples spike. It's okay, it's hanging in there, but it's not really flashing. Now, that could change quickly, but as it looks right now, it's not as viable as it did seem. And we might get down to some pivot points if we can get back up to some kind of short-term moving average. Some fib retracements that I pointed out in previous levels may, I guess initially we're looking for support, but if we really start to go up, then we're looking at resistance. And we're not in a sideways trend right now. So thank you. Have a wonderful week. And please, if you're interested in getting involved with what I do a little bit more, please feel free to check out the video when I post that. I would be very honored to have you listen to that. So have a great weekend and enjoy the 3 days if you get all 3 days off, and I'll prepare the next video next weekend.